Hello everyone. I will continue with chapter 1. So we look at further classifications of risk. Personal risk means it directly affects an individual or family. It could be death, retirement, medical conditions, and so on. Property risk pertains to damage or theft of property. So it can lead to direct loss, which is damage, destruction, or theft of property. It can also lead to indirect loss, which is a consequence of the damage or theft. For example, increased living expenses after fire in a property. Liability risks are due to legal liability after causing injury or damage. In the case of a business, we have property risk, which is damage to building, equipment, and so on. We have liability risk, which is the risk of lawsuit from customers as well as employees. Loss of business income, which can also be a source of risk. Nowadays, cyber threat is an increasing source of risk because of digital technology. Human resource exposure, which lead to workplace hazard or workplace risk for the employees. Foreign loss exposure, which is due to political conditions or acts of terrorism abroad. Intangible property exposures, that is damage to market reputation or intellectual property. And finally, government exposure, which is due to violation of regulations and norms. What is the effect of risk on society? The primary three effects we can figure out. If there is no insurance, then individuals as well as businesses have to maintain large reserve funds to cover losses. There is also the risk of lawsuit, which can constrain innovation or businesses exchanging goods and services. And finally, it leads to increased concern and fear. So to reduce the burden on society, we have different techniques to manage risk. The first is risk control, that is managing the frequency or severity of loss. Loss prevention means activities done to reduce the frequency of loss. Loss reduction means activities which are done to reduce the severity of loss. It could be duplication, that is keeping backups or multiple copies of the work being done. Separation, that is doing different activities at different places or different points of time. And diversification, which broadly means engaging in different activities so that the risk is not concentrated by doing one or few activities. The other technique is risk financing, that is providing for funds to cover losses. In this case, the companies engage in retention, that is, they absorb part or all of the losses. Retention can be active when an individual or business knowingly absorbs the risk and keeps funds to cover them. Passive retention happens unknowingly due to ignorance or indifference. Self-insurance is a special form of active retention where the company absorbs part or all of the losses. Other forms of non-insurance transfers are hold harmless contract. So in this case, I cannot hold my counterparty legally liable for any damage or other problem. Hedging means I am transferring the risk of price fluctuations to another entity who could be a speculator. And then we have incorporation. That is, the business is constituted as a company. So the owners of the company do not have responsibility for any loss. the responsibility of loss is borne by the lenders, those who lend money to the. And finally, we have insurance as the most practical method to manage risk. So what happens is an insurance company provides cover to a large number of customers. Among them, a few will suffer losses. So that loss gets distributed among the entire group. So they apply the law of large numbers, which you can study in a different chapter. That's all for chapter 1. Thank you.